Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, November 30th, 2015. In this video, we'll take a quick look at gold and the gold mining stocks via GDF and a few of the big holdings, the major gold mining companies. Before we get into the charts of gold and the miners, let's take a look quickly at the relationship between gold and the US dollar. As most of you know, gold and the U.S. dollar are very highly correlated, or more accurately speaking, inversely correlated. So what I've done here is overlaid a chart of GLD, which is the gold ETF, and UDN, which is the inverse of the U.S. dollar. It's the non-leveraged inverse U.S. dollar ETF. Now I did that because if I put up the chart of UUP or the dollar index against gold, one goes up, the other goes down. It's a little bit harder for most, visually to track and see the relationship. So by simply flipping this over, since gold goes up and the dollar goes down and vice versa, by using the inverse of the dollar, you can really see this relationship very clearly here. Now, they're not going to overlap each other because they're on a different price scale. They don't move dollar for dollar or percent to percent. It's just the trend. When the trend in the dollar is down, in other words, when we see UDN, the blue line here, going up, the dollar is moving down. And as you can see here, the relationship is nearly, when you flip it over, a nearly perfectly correlated relationship as far as the directional trend. Dollar up, or I should say UDN, dollar down, meaning UDN up, gold up, and vice versa. So you can replicate this chart on your own, but you can see it clearly here. Like everything else, all other financial assets where there's a correlation, there are temporary disconnects. So sure, you'll find a few periods here where these might be moving, these two lines in sync, but for the most part, it's very clear. And again, this is a 10-year price history here. And you can see here when gold topped back in 2011, you can see that's when the big downtrend in the dollar started. So the dollar also topped at this point here. And again, you can see the relationship. It's been very clear. So what we had here, now this is interesting. We really had the dollar fall off a cliff starting back in about the middle of last year. Very strong move down in the dollar. And yes, gold fell as well. That correlation is there. But you notice that gold hasn't fallen off a cliff. Gold, in my opinion, is becoming very sold out, and it's not as sensitive anymore as much as it has been to the move down. At least it wasn't during this point. We did have a little rally here, a little spike where the dollar dropped. That's this rally in UDN, and of course gold did rally. But we're going on right now as the dollar's making new highs or about to. Gold is at new lows, at least multi-year lows. So again, I just wanted to illustrate the relationship. Now let's go ahead and take a look at the charts of gold. We'll start with a weekly, actually. Let's flip over to a weekly chart. This is a chart that I've talked on many times and posted quite a bit on. This is what I've been watching on gold. These orange lines, which is sort of a contracting price channel. Gold's been in this downtrend. Gold really peaked back here up in 2011, but has been working its way in this channel, and I've pointed this out in the past when we were at the top of the channel, most recently at the bottom of the channel, and there was a very nice trade on gold and the gold stocks on that last tag. So where we're at today, I'll make a case in a minute here for a potential reversal in the U.S. dollar. Before I do that, I just want to take a look at the long-term chart on gold. I've talked about this major support zone here quite a bit, and that's still a possibility that we may hit that major support zone before all is said and done, meaning before the bear market in gold is over. That support zone is defined by these dotted lines. You can make out a blue and I guess that's a yellow dotted line. Those are both key Fibonacci retracement levels. One of those here, the yellow lines here, shows this reaction low back in 2009. The others to the left of the chart. I've covered those in the past. So what we have here is a fib cluster as well as price support. You see back in 2008, 2009, we had numerous attempts for GLD to get above this level here, about 90. I think that zone, you can see it, it runs from about 95 to 98, give or take. I'm not zooming in right now. But somewhere around the 98 level, gold kept pushing. We had this inverse head and shoulders pattern here. and then boom, we finally broke out and had that strong uptrend into the highs, and that ended the bull market run in gold right there. So this is, again, former resistance becomes support. So if we get down to that level, we have a couple of key fib retracement levels from the bull market in gold, or some of the major runs in gold. And but as of now, it is time to be, in my opinion, cautiously bullish. I certainly wouldn't short gold here, trying to eke out the last couple percent. We're already at, down to below 102 in gold, and the top of that zone, as I said, comes in somewhere around the 98-ish level, a little bit above that. So for a few percent downside, it is definitely not worth the risk, in my opinion, to be shorting gold, at least aggressively here. And it wouldn't surprise me to see gold fall short of that level. And even if it doesn't, again, I've pointed out this trend line here and how we've made some nice trades off that in the past. Well, gold could certainly rally here again once more, and maybe then go on later, maybe earlier in 2016, to come back down and finally hit that level before the bear market's said and done. But as pointed out, we have bullish divergences in place in the PPO, which works great on the long-term time frames. The RSI, we continue to build those divergences. In other words, as prices make lower lows, these oscillators are making higher lows. So that's positive or bullish divergence. So there's gold from a weekly perspective. Now let's see what's going on in the daily chart here. The daily chart, what we have here is, I've added this line recently. We have a divergent low. Now, I did point out this divergent low back here. We had this white trend line. I removed the trend lines on the MACD and the RSI. As of now, I'm focusing on this divergent low. In other words, from this point here in late July, early August, down to the recent lows here where we're trading today, prices in gold have made a lower low, and both the MACD, the RSI, and probably most other indicators and oscillators that you use, you'll see, are making higher lows, i.e. positive or bullish divergence. Now, what I want to see is this MACD make a bullish crossover. In other words, a signal line trade above the MACD line. That will help to confirm this bullish divergence that's in place, and we could see a nice rally in gold. Again, another buy signal here are these oversold readings. As simple as this is, and I've pointed this out many times on the site, it's highly effective. You look at the white arrows here, they mark the oversold readings. As I always say, it's not an exact timing indicator. Yes, gold became oversold here, continued to become oversold up until we cross back above at this level. Now, what you usually see is a small divergence, in other words, a higher low in the RSI at that point. And I like to always say, once you see a crossover back above the 30 level, that's usually your buy signal. But the white arrows show you here, 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 here. And these might not look like much, but this one, for example, is a rally of about 7%. And again, when you trade the miners, my preference is to use the miners, since they're effectively a leverage play on gold. The returns on the gold mining stocks are usually 2, 3, sometimes 4 times what they are on gold. So if you get the call on gold right, you can usually do a lot better trading the miners, because they are, again, essentially a leverage play on gold. And this goes back farther. The limitation on TC2000 when we're on a daily time frame is that it will only show you 2 years of price history. So if I flip over to a 2-day period chart on gold, here we go. You can see all the arrows here. Disregard this one. I'm not sure why I put this here. But here's all your oversold readings. A couple of these may look like they fell short of the 30 level, and that's only because I flipped to a 2-day time period, which skews this RSI 14. I'd have to change that setting. When we go back to a 1-day period, I'll show you these were indeed oversold readings, meaning they hit this blue line, which is the 30 level. And as you can see, without fail, I think this rally here was at least, 4 or 5% right here in gold, which again would have correlated to probably a 10-15% plus rally in the miners. And that was, I think, the smallest rally that we had following an oversold reading. So now we're looking at a 4-year price history. So again, without fail, every time gold became oversold, oh yeah, I see what that arrow, that marks the second oversold reading down there. That's what it was. So we go back to a one-day chart. Remember, this was 2014. Let's just look at the daily chart again. Okay, so here's those 2014 oversold readings. So you can see they clearly exceeded the 30 level on the RSI. And again, these are nice rallies. So in just about every case, when we did catch these rallies, we had well-defined levels to exit or take profits. So we were able to trade, the miners pretty successfully on most of those oversold readings. And again, that's where we're at right now. So we're oversold with positive divergences in place. And let's take a look now at, before we get to the miners, let's quickly look at the euro. Okay, you may notice from the timestamp on this video, it's quite a pause here. I was doing the video, we were talking about, I believe, gold last on the oversold readings, and my chart started freezing up from TC2000, and the servers eventually went down. So it took me, I had to have lunch. I came back on and noticed that all the trend lines and annotations I had for the next symbol I was going to talk about, the euro US dollar pair, those were all vanished. So I'll deal with TC2000 on the phone later today. It looks like most of my other trend lines have been saved. So forgive me if I've skipped, if there's some gaps here in the video, but what we're going to talk about now is, real quickly, we'll touch on the euro US dollar. In the beginning of the video, I went over the relationship of the dollar and gold. So again, if you get the call on the euro, if you get the call on the dollar right, you get the call on gold right, at least in the longer term, barring those short-term disconnects. So the chart that I've been posting quite a bit, especially in the trading room on the euro US dollar pair, I had a descending price channel here. I had to replicate these lines, so I just figured I'd clean it up a little bit. I don't have the lower trend line to that price channel. That would be the yellow line here, was the uppermost downtrend line of that channel. And we had a breakout recently, breakout right here. Backtest slightly made a new low backtesting the channel at this point. And since then, prices have just gone slightly below that backtest, but not by a whole lot. So what I've added to this chart, and what I'm focused on at this time, is this very well-defined bullish falling wedge. If you look at this white uptrend line here, downtrend line, we have numerous reactions starting back here. 1, 2, 3, 4, 5. We also have at the bottom of the wedge quite a few reactions there. So these white lines form a bullish falling wedge on the euro US dollar pair. And remember, this is the euro against the dollar. So if and when this pattern breaks out, which I would suspect it will, and that is in large part confirmed by these bullish divergences down here, the MACD making higher lows, the RSI making considerably higher lows. This 1333 EMA pair, which I like to use, works well on various time frames. It's confirmed that the euro has been in a downtrend for really all the way back from this point here. It gave the crossover, so it got you in pretty early and has stayed red. You see that diverging as well, meaning the 13 EMA is coming closer and closer to the 33 on each attempt and is poised to cross up and is currently ready to do so. So either way, bullish falling wedge, positive divergences in place. And so if we do get a breakout in the euro, then I would suspect, there's quite a few levels here. I haven't had time to fully annotate this chart, but I think this is a very realistic target, just above the 108, the 108.3 level on the euro US dollar pair. And just taking a look at the big picture, this is a weekly chart of the euro US dollar. Now, should we go a little lower here, right now we're close but not all the way to making a divergent low. In other words, if we put this trend line here, that's parallel. So if the euro comes down just a little bit, we're talking the euro US dollar pair needs to get to about 104.8, somewhere around there, to make an equal low. We have very strong divergences on the weekly chart. Now, the weekly chart, when you get bullish divergences on a weekly chart, they're rare, but when you get them, they're usually a precursor to a lasting trend reversal. So we had the last time we had bullish divergences in place on the euro US dollar was at this point back here in mid to late 2012. You can see the or the PPO, which I like to use on a weekly time frame, made a higher low against prices making a lower low. I'll draw it out here for you. And from there, you can see what happened. It's very clear we had this rally that lasted from July, late July, all the way, and I'll try to gauge it in price movement, all the way up to middle of May. And that was good for about a 14% rally in the euro against the dollar. Now, for those of you that are still not sold on technical analysis, you're heavy into fundamental analysis, you read the papers, you read the headlines, you hear that Draghi's going to come out later this week and probably cut their rate further into negative rate territory. The U.S., it's all but certain we're going to have a rate hike soon. Now, what I maintain is that, yes, I fully incorporate fundamental analysis into my trading, but I also can tell you this, that the markets look out 6 to 9 months in advance. This drop in the dollar against the euro from this point here, when it peaked back in May, early May, that was a drop to the lows, and we're almost at these lows back in earlier in the year. I'm trying to measure it out here. Bear with me. That's a 25% drop. That is a massive drop in the world's, the world's reserve currency in the dollar against the euro. So a 25% drop tells me that most, if not all, of the fact that the U.S. is in better fiscal shape, that we are going to be the first to lead on raising rates. That's a large part of that. You can't even argue that a large part of it's been priced in. The million-dollar question, has it all been priced in? So there it is. From a fundamental perspective, how much more downside does the euro have against the dollar? In other words, how much more upside does the dollar have? So again, we'll see. But this would, as I said, all we have to do is get a little bit lower in the euro. That gives us an equal low in prices against higher high in the PPO, RSI, and these are very strong divergences. Should we go even lower? That's a possibility. These divergences, it would take just a virtual collapse in the euro against the dollar to negate or undo these divergences. In other words, to see the PPO come from this level to exceed this trough low down here. Same with the RSI. So it's almost a sure bet that we're going to get that bullish divergence. If we reverse here, it's just shy, and technically prices didn't make a lower low, but they're almost equal low. So that's that. Let's move on. And again, just go back to the beginning of the video where I made the case very clear that gold will trade inverse to the dollar. So if we do get a reversal on the dollar soon, which it looks like here from these charts, then things look good for gold. Now let's go ahead. We already covered the charts of gold. Let's move on to the gold mining stocks, and we'll start with GDX. I won't spend a lot of time on this. We'll only look at just a few of the top holdings in GDX, the largest mining stocks. This is a chart, again, covered many times. Really, I always start out at the weekly charts and try to work my way forward. Same story that we've had in place for a long time now, for many, many months, even a couple of years. We have bullish divergences forming on the PPO, the RSI. In other words, prices are making lower lows, very sharply lower lows, steep. That's a steep downtrend line here, while the PPO, RSI, and most other indicators and oscillators on the weekly time frame are making higher lows, i.e. bullish divergence or positive divergence. I've had this drawn as a descending broadening wedge pattern. We have 1, 2, 3 reactions up top, and now 1, 2, 3, 4 on the bottom. We've been able to go long and make some nice trades. I know we exited that. This was going back to, earlier in the year. This midpoint here, we had this horizontal resistance. That was a good time to get out of the mining stocks. And, we've traded these long and short since. And again, we're down here at the bottom with this bullish divergence in place. So, is the bottom here yet in gold and the miners? It could be. We'll only know that in hindsight, but I can tell you again, I would rather be looking for long side opportunities here than more shorting opportunities with these divergences in place. Zoom down to a daily time frame chart. I have not had time to clean it up. Apologize for that, but if you look at these lines here, the white trend lines, this was a bullish falling wedge, had a divergent low, broke out, And again, just to illustrate, the effect that the miners have, the price of gold has on the miners. What I'm doing is putting the crosshairs, capturing that low just to the left of it in September to measure up. I missed that. Try it again. And that was in the GDX alone about a 36% rally off the lows. And even if you waited till the wedge breakout there, there was still a 20+% rally in GDX. So prices have fallen back down. Again, there's that divergent low I like to look for. We had a trend line break and a nice trade in the miners. Most recently, I believe I've highlighted this on the 60-minute chart. We zoom in here. Here's a bullish falling wedge, positive divergences. We've had a couple whipsaws here on this 1333 EMA. But we did have bullish divergences in place, and so far that's a nice clean breakout. And if the most important thing here is we have a series of higher lows so far. Let's try to just mark these up real quick. So we have this low here, we have a higher low there, and so far a higher low there. Now what we need to do is take out this downtrend line. Let me clear these drawings. I've drawn a downtrend line here, put it right up there. So we have this downtrend line. Prices are sort of wedging. It's almost a triangle type pattern. So let's look for a break of this downtrend line. This was the first target zone on the last trade. We had a really nice trade on dust recently, and I've left that on the site because so far all we've done is pulled back to about the breakout point in this R1 level. That was former resistance. It was taken out, so now that's support. I should change that to S1, meaning first support level. And we've had 2 successful tests of that level. And so again, I'm looking, I'm still near-term bullish, looking for that next thrust up to this 1445 level in GDX. And to do that, a break of this downtrend line will be the first buy signal, but most importantly will be a break of these the reaction highs here just back a couple weeks ago. And I'm trying to get the crosshairs there. Say about 1407. So really a break, anything over 1410 should open the door for move up to 1445. That's a nice thin zone there. So that's GDX. That's the long and short term or near term outlook. And we'll just look at a few of the miners real quick, and then we'll wrap this up. Now what I have on here is a watch list of related items you can see here, and they're ranked. I've sorted them by market capitalization. So we're going to start with GG, about a $9.5 billion company. And this is a weekly chart of GG. Here's those oversold readings that I point out on GDX. And let's just go back. We're looking at 10-year price history. So here's the first one. We'll have to just put the crosshairs on that. Let's try to do that. So we were oversold at this level, so right here. And, it's easy to play the high to low game, but it is what it is. That from that oversold level on the weekly chart, that's about 160% rally. The next time we became oversold was right here, and that led to a a multi-year run of about 280%. So you get the point. Even the smaller ones. Excuse me. Let me clear these trend lines and take a look here. So even some of the smaller ones like this, and this was a divergent low, that was good for, it may not seem like much on this chart, but there's about a 47% rally. And what I often notice, sometimes you do get these single, especially when you have a sharp move down, like these meltdown scenarios you see here in GG. We went from being overbought to oversold in very short order. Other times you come down a more gradual manner, more controlled descent. And on those cases, you usually have this divergent low, and that's what I like to look for. So you get a reading. We had a kiss here, oversold reading on the weekly chart. Then we came back to put in a slightly higher low, i.e. positive divergence on the RSI. That was really, if you mark it up here, you can see the 2 price points there. So that was a divergent low, and that led to that rally there. Here you can see we became oversold, and the RSI had a couple more moves down, but they were each higher than the previous move. So in other words, again, divergent low up to that point, and then boom, a nice rally. And again, it might not seem like much, but you're talking well into the double digits in each and every one of these. So trading is all about looking at excuse me, past patterns, and then trading those, recognizing those patterns and similarities on the chart. So here we are, recently coming off a deeply oversold reading right here, and prices went lower. But what we see here is the RSI continues to make higher lows. So we have, as I've drawn it here, a nice strong divergent low. You can draw this large wedge pattern that's on the weekly chart. So again, I'm really warming up to the gold stocks at this time. Daily chart, I like to see some bullish divergence there as well, which we have here. So there's a MACD divergent low, with prices making a lower low, the MACD making a higher low. It's pretty strong divergence on the RSI. Again, that was just pointed out on you can see that on the weekly chart as well. So there's GG. And we'll just look at a couple more. Here's Newmont, recently put in this very steep. We had a pretty well-defined downtrend line. It was very steep. And in trading, the steeper a trend line, whether it's an uptrend or a downtrend, usually the more the sharper the reversal, I should say. So we had a breakout and a near vertical run higher, a little consolidation and another thrust up to fill that gap. I should have that line right at the bottom of that gap right here, and you can see, look at that perfect gap fill, gap backfill. So that, the stock needed a breather. It had that run. It broke out of the rising wedge pattern, had a run from the lows of about 33%, and it's only natural. Pulled back, it's digested some of those gains, still well above the recent lows. So like a lot of the other gold stocks, it's maybe a little too early to call this an uptrend, but from a very short-term perspective, we are making, you can see, a series of lower lows so far and higher highs from this peak to this peak. So the next true bullish technical event for Newmont would be to take out this previous reaction high. First of all, to hold in these lows right here to keep that higher low in place, move on up, and then take out this. Now we'll have a pretty clear series of lower lows and higher highs, i.e. a new uptrend. So that's Newmont. And I think, did we already look at the weekly on Newmont? Let's take a look here. No, we didn't. So there's Newmont on a weekly chart. Same story. You can take a look yourself. Just put these up on your chart. You can see how well these oversold readings have led in without fail. In all instances, rallies ensued shortly after, not always right away. Here's one where we had prices become oversold, and it took quite a while for that next, but we had a nice divergent low. As you can see here, the RSI, it's not drawn out here, kept putting in a series of higher lows, and eventually we had, from this point here, just a few months later, a very nice move up. Now we have this downtrend line. We had a breakout of this downtrend line. We had a divergent low at this point. It's drawn there, and that's a very strong move. Again, it doesn't look like much with a log scaling chart, but the stock bottomed here around 15.5. Yeah, that's just recently. I'm sorry. When we were here, we bottomed around 18 and moved all the way up to 27. So nice tradable run. And so far, there's that trend line that, as I had it before, we had a back test and move higher. We've come back in within that wedge and now broken above it again, back tested, and seem to be moving higher with even more powerful divergences in place at this point in time. All right, last one, we'll wrap this up. This is ABX, Barrick Gold. Weekly time frame, same story. Try to go along on these divergent lows, on or about them, especially if you're looking, to position for a multi-week or multi-month trade. Worked well then, worked well back at this point right here. Again, try to put it in perspective. Doesn't look like much, but from that point where we hit that oversold reading, we're looking at nearly a 40% gain. Happened again here. This one we had a very deeply oversold reading, and I didn't mark. I could draw a little line up to this next oversold reading, which came just a couple months later, and then a nice sharp move off there, probably again another 30 or so percent. Oversold right here with a double tap, two consecutive oversold readings with the second one a little bit higher, right where the vertical line is. And again, nice little run and get from there to there. We're looking at 35%. So as history shows us, we're oversold here. We've come back, made another higher oversold reading. We also have this bullish divergence in the on the PPO, and this long-standing divergence, which we haven't had in a long time. Keep in mind these lines here are what paint, at least for me, the bigger picture that instead of hitting these little bear market rallies, which I have no problem doing that, trading these stocks for 20, 30% runs, at one point this bear market will be over, and this is indicating that that point may be sooner than later, and instead of a 30% run, we may be looking at a 200% run. Eventually, I'd like to see, we have some resistance here. I don't have it all drawn out. I'd put a horizontal line there around 850. We'd come up to some resistance around there, 1020-ish. The rest of the lines are drawn out. But this downtrend line, this would be a next signal. Well, you want to see if the first buy signal here, there's a gap there as well around that 850 level and these reaction highs. That would be very bullish for ABX to get above. Then it would have this downtrend line to contend with, as well as some price resistance there. But once that's taken out, I think it would be safe to say that the bear market is most likely over, assuming that you can confirm that with the charts at GDX as well as gold. So for now, just on the lookout for some trades, which, as I often state, these swing trades have the potential to morph into longer term trades. So we just have to play them as they come. There's been a few times where it looked like the miners might really be off to a new bull market, and that didn't prove to be the case. But if you've trailed stops up or if you took profits at some of these near-term targets, then you were able to book some profits or at least protect a lot of those gains if when the stocks reversed and stopped you out. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.